Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
MGM Resorts International operates trophy casino resorts on the Las Vegas Strip, regional U.S. properties, and in Macau through MGM China. It also co-owns BetMGM, a leading U.S. digital sports betting platform.
The company traces to 1986, when Kirk Kerkorian opened the original MGM Grand. Two transformative acquisitions, Mirage Resorts in 2000 and Mandalay Resort Group in 2005, assembled today's Las Vegas portfolio.
The Las Vegas Strip segment generates about $3.8 billion annually from Bellagio, MGM Grand, Aria, Vdara, and Mandalay Bay, properties that attract conventions, luxury leisure travelers, and gaming enthusiasts worldwide.
Regional operations add $1.7 billion from U.S. casinos outside Nevada. MGM China contributes $1.3 billion from Macau gaming. That geographic diversification provides some resilience when any one market faces disruption.
Casino resort economics combine gaming revenue, table games and slot machines, with hotel, food and beverage, and entertainment income. RevPAR measures hotel pricing. Gaming hold reflects statistical outcomes across table play.
MGM Rewards has more than 40 million members, a powerful loyalty asset. Members earn points across all properties, creating switching costs and enabling personalized marketing that drives repeat visits and higher spend.
BetMGM, a 50-50 joint venture with Entain, operates in more than 25 U.S. states for sports betting and iGaming. It has built meaningful market share and continues expanding as states legalize online gambling forms.
CEO Bill Hornbuckle took the top role in 2020 during the COVID shutdown, one of the most disruptive periods in gaming history. His 3 decades of MGM operations experience helped manage the crisis and subsequent recovery.
The COVID shutdown tested the business severely. All U.S. properties closed for months. MGM emerged with a leaner cost structure, having used the period to renegotiate contracts and accelerate digital investments that proved valuable on reopening.
MGM reinstated its dividend in 2023 at a modest level, about 20 cents annually. The more significant capital return has been share buybacks, which have reduced the share count materially over the past several years.
Wynn and Las Vegas Sands are the most comparable Strip operators. Caesars is also a major Las Vegas presence. Competition centers on conventions, entertainment acts, room quality, and loyalty program benefits, all areas where MGM competes credibly.
Las Vegas RevPAR, Macau recovery velocity, and BetMGM's path to profitability are the 3 primary metrics that define the long-term trajectory of this business. Each one drives a different segment of earnings.
MGM's Las Vegas portfolio benefits from irreplaceable real estate on the Strip. These properties cannot be rebuilt, and their scale for conventions and entertainment creates competitive advantages that pure gaming operations lack.
For investors, MGM blends Strip real estate premium, recovering international exposure, and digital optionality through BetMGM, all in a capital-intensive but cash-generative hospitality model.
That's the company chapter for MGM Resorts International. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
MGM Resorts just delivered a record top line and a margin reality check in the same quarter. Q1 2026, net revenue $4.45 billion, up 4% year over year. Adjusted EPS 49 cents, a 14% miss versus the 57-cent consensus. Las Vegas Strip back in growth for the first time since Q3 2020-24. BetMGM officially profitable. This is Charged Alpha. Let's break it down.
MGM Resorts owns the largest collection of casino resorts on the Las Vegas Strip. Flagships include Bellagio, MGM Grand, Aria, Vdara, the Cosmopolitan, and Park MGM, plus regional casinos. Outside the U.S., MGM operates MGM China, Macau, and Cotai, and runs the BetMGM sports betting and iGaming joint venture with Entain. Market cap sits at roughly $10.1 billion.
The structural piece to understand. MGM no longer owns most of the real estate under its Strip casinos. Years ago, the company executed a sale-leaseback with what is now Visi Properties, the casino REIT. MGM took the cash, kept the operating businesses, and now pays Visi rent. That single decision is why the balance sheet shows $56 billion in reported debt while market cap is only $10 billion.
Net revenues came in at $4.45 billion, a record first quarter, up 4%. Segment breakdown: Las Vegas Strip Resorts flat, regional operations up 2%, MGM China up 9%, MGM Digital up 43% to $183 million. Revenue beat the Street's $4.37 billion estimate by 2%.
The miss was on the bottom line. Adjusted EPS 49 cents fell short of the 57-cent consensus, 14% shortfall. Operating income dropped to $301 million from $385. Net income fell to $175 million from $227. Adjusted EBITDA $580 million versus $637 prior year. Three culprits: higher MGM China gaming taxes, a $46 million bump in self-insurance reserves, and lapping last year's cybersecurity insurance proceeds.
Las Vegas Strip metrics: occupancy slipped to 92% from 94%. Average daily rate held flat at $257. RevPAR declined 2% to $238. Group room nights for the rest of 2026 are pacing up 12%, and visitation is up 11%, which is why management framed the Strip as back in growth despite the soft RevPAR print.
BetMGM had a milestone quarter. Net revenue $696 million, up 6%. Adjusted EBITDA of $25 million, officially profitable. The JV is now tracking toward the $500 million EBITDA target management guided for 2027. After years subsidizing customer acquisition against DraftKings and FanDuel, the digital business is finally generating positive operating leverage.
Now the $56.2 billion debt figure, because it is the most misunderstood number here. The vast majority is operating lease liability, the present value of future rent owed to Visi Properties for the real estate MGM sold them. It is not bond debt. There are no traditional covenants, but the rent is a real ongoing cash obligation. That is why net margin is only 1.2%. Most of the operating profit goes to the landlord.
Cash position: cash on hand $2.06 billion. Free cash flow trailing 12-month $1.64 billion. GAAP net income runs thin because of lease accounting, but cash generation is materially better. Lease payments split between principal and interest in funky ways. That mismatch is why analysts value MGM on EV to EBITDA, not PE.
Wall Street is divided. 3 buy ratings, 4 holds, 2 sells. The average price target is $42.58. With the stock at $36.93, that implies roughly 15% upside over 12 months. The high target sits near 60, the low near 29. That 2-time spread tells you analysts genuinely disagree on this name.
The valuation framework matters. Forget headline PE. For gaming companies that lease their real estate, the right metric is EV to EBITDA, which captures equity value plus rent obligations. MGM trades at roughly 8.5 times EV to EBITDA, reasonable for a casino operator of this quality. Price to sales is just 0.58. Forward PE on the consensus 196 is around 19. None of those scream expensive.
The bull camp argues MGM has 3 independent profit pools, all moving the right direction. Las Vegas group recovery, Macau mass market reaccelerating, and BetMGM finally generating EBITDA. If all 3 play out through 2027, current EBITDA expands materially, and the stock re-rates higher with no multiple expansion needed. The $17.7 billion forward revenue estimate supports that thesis.
The 2 sell ratings are pointed. First concern, the gap between adjusted and GAAP earnings. Adjusted EPS 49 this quarter, GAAP 48. The gap is small, but bears argue long-running add-backs for cybersecurity, restructuring, and JV losses obscure how thin underlying margin really is. Net margin 1.2% leaves no room for error.
Second sell-side concern, the lease structure itself. Even though the $56 billion is operating leases, not bonds, rent escalators with Visi step up annually. If Strip occupancy or rate softens for 2 or 3 quarters, the rent does not flex, it is fixed. That asymmetric exposure keeps beta at 1.35 and justifies the lower-end targets. Bulls call it operating leverage, bears call it fragility.
Bull case starts with BetMGM scaling toward the $500 million EBITDA goal by 2027. That alone could add $2+ to MGM's per share value at any reasonable multiple on digital gaming earnings. $696 million in net revenue this quarter says the platform has scale. Now it just needs to keep showing margin discipline.
Second pillar is Las Vegas Strip supply constraint. You cannot easily build new mega resorts on the Strip. Land, water rights, and gaming license dynamics make new supply structurally limited. That gives MGM, Wynn, Caesars, and Sands long-term pricing power on the existing room inventory. With group bookings pacing up 12% for the rest of 2026, that pricing leverage is intact.
Third is Macau. MGM China revenue up 9% this quarter as the mass market segment continues to recover. Macau gaming revenue is structurally tied to Chinese consumer wealth and travel patterns. As intra-Asia tourism normalizes through 2026, MGM China's contribution to consolidated EBITDA grows, and that segment carries higher margins than U.S. regional casinos.
Bear case anchors on consumer spending. The 2% RevPAR decline and occupancy drop from 94 to 92 are early warning signals. Las Vegas is discretionary. When budgets tighten, conventions get cut, and leisure travel pulls back. If the U.S. economy softens in the back half of 2026, MGM's Strip exposure becomes the swing factor.
Second risk. BetMGM is profitable, but still trails DraftKings and FanDuel in U.S. share. Those two have been rational on pricing in 2026, but if they push promotional spending again, BetMGM's $25 million quarterly EBITDA evaporates fast. Digital gaming is winner-take-most, and MGM sits third in many states.
Third risk, lease obligations. The rent owed to Visi is fixed and contractually rising. There is no flex. If Strip EBITDA compresses, free cash flow after rent compresses faster. That is the mechanical reason the two sell ratings exist and why beta sits at 1.35. Leveraged operating businesses move with bigger amplitude than the market.
Fourth, Japan timeline. The Osaka Integrated Resort is funded at $200 to $225 million in 2026 capex, but does not open until 2030. That is 4 years of investment with no offsetting revenue. Cost overruns would compound the lease burden and pressure the buyback capital return path.
Peer group Wynn Resorts, Las Vegas Sands, Caesars Entertainment, and DraftKings on the digital side. Among the casino operators, MGM has the broadest U.S. footprint and the deepest Las Vegas Strip exposure. Over half of consolidated EBITDA comes from the Strip. That concentration is both the bull and the bear case, depending on your view of Las Vegas demand.
Versus Wynn. Wynn is the premium tier in both Las Vegas and Macau. Higher ADR, higher VIP exposure in Macau, smaller absolute footprint. Wynn trades at a premium EV to EBITDA multiple because its margin profile is structurally better. MGM is the volume and scale play. Wynn is the luxury margin play.
Versus Las Vegas Sands. LVS sold its Las Vegas operations years ago and is now essentially a Macau and Singapore pure play. Different exposure, different cyclicality. LVS will outperform when Asian gaming is hot. MGM benefits more from U.S. domestic strength. Owning both gives you a barbell on global gaming demand.
Versus Caesars. Caesars is the closest comp. Similar U.S. regional and Las Vegas Strip footprint, similar sale-leaseback debt structure with Visi, and similar exposure to BetMGM-style digital build-out through their Caesars Sportsbook arm. The two stocks tend to trade in correlated ranges. The decision between them often comes down to property mix preferences and balance sheet timing rather than secular thesis.
Options activity around the print was active. Implied volatility was elevated heading into earnings, with the options market pricing roughly a 6% post-earnings move. The actual move was smaller. The stock dipped on the EPS miss, but the revenue beat and BetMGM profitability cushion limited the downside. Anyone short volatility into the print captured a clean premium decay.
Open interest skews neutral to slightly bullish in the front-month chains. Calls at the 40 and 42.50 strikes show institutional positioning for a recovery toward the analyst price target of 42.58. Put open interest concentrates at 35 and 33. Those are the levels where bulls would defend and where bears would press if Strip RevPAR weakens further.
Insider activity has been characterized by routine 10b5-1 selling, pre-scheduled, non-discretionary trades. There has not been a notable open market insider buy in recent quarters. management has been more focused on share repurchases at the corporate level. CEO commentary on the call hinted at potentially accelerating buybacks given the current valuation gap.
Institutional ownership is roughly 75% of float. The largest holders are the index complex, Vanguard, BlackRock, State Street, plus IAC, which retains a significant equity stake from the original Diller-led activism. IAC's continued involvement is a structural support for capital return discipline. When insiders own meaningful stakes, buyback programs tend to remain a priority over empire-building capex.
Bottom line on MGM, revenue at a record, BetMGM finally profitable, strip back to growth. The adjusted EPS miss and the structural lease burden keep this in show-me territory. The 42.58 target implies 15% upside, but the two sell ratings are not noise.
Charged Alpha rates this a tactical hold with bullish optionality. Watch BetMGM toward 500 million EBITDA, strip RevPAR through summer, and any accelerated buyback commentary. If those three signals turn green, the stock works to the upper end of the range.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.